$1,000 a month. That's the number a lot of you have in your head right now, and honestly, it feels small. Real investors have hundreds of thousands sitting there already, growing on its own. You're just feeding scraps into an account every month and hoping it turns into something before you're too old to enjoy it. That thought is wrong. I can prove it with actual numbers, not a vibe. By the end of this video, you're going to know 3 things. First, the exact dollar figure $1,000 a month turns into after 25 years inside a specific group of stocks called the Dividend Aristocrats. And I'm going to show you 3 versions of that number, from conservative to what happened over the last 35 years. Second, the one rule inside this group of companies that most people watching Dividend Aristocrat videos on this platform have never heard, and it's the exact mechanism that keeps this list honest. Third, the mistake that quietly cuts this number in half for people who think they're doing everything right. That number comes first, since it's what you clicked for. Put $1,000 a month into the Dividend Aristocrats Index for 25 years, reinvest every dividend along the way, and the range looks like this. At a conservative 7% average annual return, around $810,000. At 9%, which sits below both the index's actual long-run average and last decade's performance, $1,121,000. And if the next 25 years look like the last 35, which is not a promise, just history, $1,750,000. That last figure comes directly from S&P Dow Jones Indices data, which puts the Dividend Aristocrats' annualized return since 1990 at 11.6%. You put in $300,000 of your own money across those 25 years. The rest is the market doing what markets do when you stop touching it. Now, before you screenshot that number and go buy the first ticker you see with dividend in the name, we should talk about what the Dividend Aristocrats are, because most people get this wrong, and getting it wrong is exactly what causes the mistake I mentioned a minute ago. Section 1. The Aristocrat Filter. To even get on this list, a company has to be a member of the S&P 500, and it has to have raised its dividend every single year for at least 25 consecutive years. Paying a dividend isn't enough. It has to go up every single year. There are only 69 companies on Earth that currently clear that bar, according to S&P Dow Jones Indices, which runs the index and updates the list every January. That's out of 500 companies in the S&P 500 itself, and thousands of publicly traded companies in the US. 69. Almost nobody explains how this index is built, and it's the more interesting part. It isn't weighted by company size the way the regular S&P 500 is, where a handful of giant tech companies control most of the movement. The Dividend Aristocrats Index gives every single company an equal slice, roughly 1.5% each, and rebalances that back to equal every 3 months. No single company, no matter how big it gets, can quietly take over the index. S&P also caps any one sector at 30% of the total weight, which is why, even though this list leans toward boring, stable businesses like consumer staples and industrials, you're not accidentally betting your future on one industry having a good decade. One fact surprises even people who've watched a dozen of these videos already. Real estate investment trusts, REITs, are legally required to pay out at least 90% of their taxable income to shareholders every year. You'd think that rule would make REITs the easiest group to fill this list with. It's the opposite. Only 3 REITs currently qualify as Dividend Aristocrats. When you're forced to distribute almost everything you earn, there's no cushion left to guarantee an increase every single year through a recession, which is exactly what this list demands. Call that the REIT Paradox. The very rule that makes REITs generous with dividends is the same rule that makes most of them unreliable at consistently raising them. That matters, but it doesn't fully protect you, and this is where the freeze trap comes in. Section 2. The freeze trap. Most people assume a company gets kicked off this list when it cuts its dividend. That's true, but it's only half the rule. And it's the half most dividend investors never hear. A company doesn't need to cut anything to lose its spot. If it just holds the dividend flat for one single year, no increase at all, it's out at the next January review. Freezing is treated the same as cutting. This has happened to some big names recently. AT&T lost its spot in 2022 after spinning off Warner Media and resetting its payout to match. 3M lost its status in 2024 when a healthcare spinoff forced a dividend cut. Walgreens got removed the same year after an outright reduction. None of these were companies that quietly went bankrupt. They were structural events, spinoffs, and restructurings that broke a streak that in some cases had lasted decades. Why does this matter for your $1,000 a month? Because if you tried to build this strategy yourself by handpicking 20 or 30 individual aristocrats, and one of them freezes or spins off a division, you're now holding a stock that no longer belongs in the strategy you built, and you have to notice, decide, and act. The equal weight 69 company structure exists specifically so that one company's freeze doesn't blow up your plan. That's the actual value of the index wrapper, not just the 69 logos. The mistake I promised at the start is the one that costs people money. Section 3. The yield chase mistake. Almost everyone gets one thing wrong the first time they hear Dividend Aristocrats. They assume this list is full of high-yield stocks because dividends and high yield feel like the same thing. They're not. The average yield across all 69 current aristocrats is around 2.5%, according to current market data. Compare that to some of the high-yield dividend stocks and funds you see pushed hard on this platform, some yielding 6, 7, 8% or more. If you go chasing that higher number instead, you're usually not finding a better version of the aristocrats. You're finding a company under financial stress, propping up its stock price with a payout it might not be able to sustain, which is exactly the kind of company that eventually cuts and gets removed from lists like this one. The aristocrat's edge was never the current yield. It's the dividend growth rate, which has run around 6% a year on average over the last decade. A smaller check that grows 6% every year, compounding for 25 years, beats a bigger check that gets cut in year 12. That's the whole thesis in one sentence, and it's also why so many high-yield dividend products online are not the same asset as what we're talking about tonight. Now the math, step by step, so you can run this against your own number instead of taking my word for it. Section 4. Run your own number. Start with your monthly contribution, multiply it by 1,121. That's your 25-year projection at the 9% baseline I used earlier. The conservative but realistic assumption sitting below this index's own history. If you're putting in $500 a month, because that's genuinely what your budget allows right now with a mortgage and a family and everything else pulling at your paycheck, that's 500 times 1,121, which lands at $560,500. You'd have contributed $150,000 of your own money to get there. If you're at the full $1,000 a month, you already know the number. $1,121,000 on $300,000 contributed. And if you're able to push to $2,000 a month maybe once the mortgage is further along or a raise comes through, you're looking at $2,242,000 on $600,000 contributed. Same 25 years, same strategy. The only variable is what you can put in every month, and that number scales in a straight line. That's the compounding multiplier. Your monthly number times 1,121 equals your 25-year projection at a growth rate grounded in this index's real history, kept deliberately conservative. Adjust the multiplier up if you want to model the 11.6% full history figure, or down if you want to stress test a rougher stretch of markets. The math is yours to run either way. There's a second number hiding inside that first one that most projections never show you, and it's the one that matters most if your goal is living off this money someday, not just watching a balance grow. At the $1,121,000 outcome, using today's average aristocrat yield of roughly 2.5%, that portfolio would be generating around $28,000 a year in dividend income the moment you stop contributing. Not $28,000 once. $28,000 that grows every year going forward because that's the entire discipline this index screens for. That's a real number you could receive as cash, spend, or keep reinvesting. And it exists completely separate from whether the stock price goes up or down that year. Before you run off and open a brokerage account, one thing the IRS makes almost nobody aware of until it costs them money. If you're reinvesting your dividends automatically through a DRIP in a regular taxable brokerage account, every one of those reinvested dividends is taxable income in the year you receive it, even though you never see a cent of it yourself. The money goes straight back into more shares, and the IRS still counts it as if it landed in your bank account. For 2026, qualified dividends are taxed at 0% if your taxable income is under about $49,450 single or $98,900 married filing jointly, 15% through $545,500 single, and 20% above that, per IRS guidance. Inside a Roth IRA, none of this applies at all. The dividends grow and compound completely untouched by any of these brackets. Which account you use for this strategy is a real decision with real tax consequences, and it's worth sitting with before you pick one, not after. One more honest caveat, because this audience checks the math, and you should. The Dividend Aristocrats Index itself has only been trading live since May of 2005, so there isn't a full 25 years of live, non-backtested history to point to yet. What we do have is the broader pattern across 150 years of S&P 500 data, where no 25-year stretch, and honestly no stretch longer than about 16 years, has ever ended with a loss on a total return basis. That's not a guarantee for the next 25 years. Nothing is. It's just the pattern every generation before us has lived through, including 2008, when the Aristocrats index fell about 22%, while the broader S&P 500 fell closer to 37% the same year. Lower highs during the good years, in exchange for a shallower hold during the bad ones. And that timing matters, because as of this summer, the Federal Reserve is holding rates at 3.5 to 3.75%, and inflation is still running around 4% a year, hotter than the Fed wants. That's not a reason to wait. Waiting has never once been the strategy that built anyone's $28,000 a year in growing income. It's a reason to know that the number on your screen today needs to keep growing just to hold its value, which is exactly what a dividend growing 6% a year inside a strategy built to survive both booms and downturns is designed to do. 4 things to hold on to. The Aristocrat Filter gives you 69 companies with a proven audited 25-year discipline, equally weighted so no single one can sink the plan. The REIT Paradox is the reminder that even an industry built to hand out cash doesn't automatically qualify, because paying a lot and growing a little are 2 different skills. The freeze trap is the rule that keeps that list honest, removing anyone who so much as pauses their dividend growth, which is exactly why the index structure matters more than any single stock pick. The yield chase. Mistake is what happens when you confuse a high current payout with actual quality, and go looking for a bigger number instead of a growing one. And the compounding multiplier is the formula you now own. Your monthly number times 1,121 is your real 25-year answer, not somebody else's. Drop your own number in the comments. Not your income, not your age, just what $1,000 a month or whatever your real number is turns into for you using this multiplier. I read every one of them. If you want to know exactly which fund or funds hand you this whole list in one purchase, instead of handpicking 69 tickers yourself, go watch The Best ETFs to Live Off Dividends in America right after this one. It walks through which ones to look at and why, using the same kind of real numbers you just watched. You came into this video thinking $1,000 a month was too small to matter. It isn't. It's $300,000 of discipline turning into over $1 million of somebody else's money working for you, and a growing paycheck that shows up whether you feel like working that month or not. The people who think $1,000 a month doesn't matter were using the wrong number. Now you have the right one.